What else should you be looking for to de-risk deals?
Okay, so a handful of other things. Number one, I want to know that a sponsor has their own money in the deal. And realistically, I would like to know that they've got, a decent amount of cash. And the size of the syndication, the size of the dollars in play is going to impact what that looks like. But I often like to see a GP in at 5% or somewhere around there of the total. A much larger deal is going to be different than that, and a much smaller deal might require them to be at 10%. But I just want them to have significant skin in the game, where they are, they're going to lose. If the deal doesn't go well, they are going to lose. I want there to be incentive for them. Besides making money, I want there to be incentive for them losing their own money in making the deal go well. And then, we talked a little bit about fee structure. So let me expand on this. In fees, this is where you see a lot of GPs making more money is, a fee for everything under the sun. And this, by the way, is where you can find like the difference between a retail investment, which is like high fees because your retail investor doesn't know better. They don't know the difference. Or, something that is reasonable in fees, which, would not be a retail type of investment. It's something that's more investor friendly and really more what I would say is standard. As a standard thing, the fees should be reasonable. I'm okay with people making fees because you got to pay your staff. But there are some groups that put fees based on, for example, the asset value, but you're not using all equity in most cases to buy an asset. You're using leverage, you're using some debt. So that's not a great way to charge fees on the total value of the asset. That to me is not reasonable. You could do it based on, I've seen it based on committed capital. I don't like that either, because if it hasn't actually gone in, and you haven't actually made those contributions, you're being charged a fee on money that hasn't been put in. I don't like that either. I like invested capital. And I want to see a reasonable fee across the board for everything. And you can check, deal by deal by deal and just, measure up and see what that looks like. But, that would be one thing I would definitely dig into, because a lot of sponsors and GPs, I'll use those terms interchangeably. They're notorious for being high fee. So that means they make money even if the deal goes bad. I was looking at a deal not too long ago where the GP made a ton of money, like within days. And so if the deal went poorly, it didn't matter. Like they were already, I think it was $3 million of fees that they made right out of the gate, just based on one fee metric, where they were in the money, even if the deal went bad. That is an egregious misalignment to investor, sponsor, relationship there. And I don't like that. So that's really important. I would say track record is important. A lot of people have only been in business syndicating for 5, 6, 7, 10 years. So they don't know what this new season of investing is going to look like and feel like. They don't, they haven't tested the raging waters, the bigger waves that happen in an economic season that is not as wonderful as what we've experienced. So I like seeing people that have been through the 2008 financial crisis. I like seeing people that have been through the dot-com crash. Those two eras, if we can get two different times, and that's about 20 years. I like seeing that experience. I think that's really important. And then I also think one of the greater indicators and metrics to look at is past deals. So what was their pro forma on their past few deals that have gone full cycle? Meaning they've gone all the way to the end and investors have made a return and the asset has been sold. And for a lot of these syndicators, they've never even had a deal go full cycle, right? So like there is no history, there is no track record. But what I'm excited about is finding people that have gone through it and the pro forma matches up. So anyone could put in a pro forma like, oh yeah, we're going to do 25% IRR. And an inexperienced investor is going to say, ooh, that sounds really good. And they're cashing paychecks before it actually happens. That's not a good way to do it, because what they put today it's irrelevant. Like, I could put any number I want. It has no bearing. What I do care about is, what was your last deal's IRR? What did you put in the pro forma? And then what was actually the result of it? And did you equal the projection, exceed the projection, or did you fall below the projection? And how many others in the past actually met and exceeded, ideally, the criteria that you had in the pro forma? That to me is like the best indicator of being able to hit your numbers. And that's where I can have trust in a pro forma on a current deal, because I know that their history is good and they've had recessions in their background. And then I think the exit strategy matters. Like, what is the plan? Is the plan to hold this long term? Is the plan, is this a value add? Everyone, the catchphrase is value add. So everything's been a value add. But is it a true value add? Meaning you're buying an asset that you can instantly add value to, you can rehab it, and you can bring rents up to market. And so you're kind of locking in a gain there after that work's being done. And then there's a chance to refi it out, where you can take some of the equity off the table and pay investors. And then maybe there's the plan that you're going to sell it in 5 years or 10 years, or this is a hold, forever. And understanding that, I think all those are really, really important.